If you're self-employed and you've been putting money into a 401k, thinking you're doing everything right, I need you to watch this entire video, because there are at least 3 ways that account is quietly working against you, and most financial channels will never tell you about them because they're too busy explaining what a 401k is instead of why it breaks for people like you. So here's what this video is actually about. You've probably heard that freelancers should open a solo 401k or a SEP IRA, max it out, and call it a day. That's the standard advice, and it's not wrong exactly, but it leaves out about half the picture, the half that costs you real money. I've gone deep on the specific ways these accounts fail freelancers and independent contractors, and what I found is that the problems aren't random. They follow predictable patterns that almost every self-employed person hits at some point. So we're going to go through the ones that matter most, starting with something that sounds boring but is genuinely one of the most damaging traps in the whole system. Let's start with the quarterly tax timing problem, because this one flies completely under the radar and it creates a cash flow nightmare that most freelancers don't even realize they're in until they're already stuck. Here's how it works. As a freelancer, you're required to pay estimated taxes every quarter: April, June, September, and January. And the way you figure out what to pay is by estimating your income for that period. So you sit down in January, you estimate your Q1 income, and you send a payment in April. Straightforward enough. But then in May, a big client lands in your inbox. Suddenly your income is way higher than you estimated. The problem is you can't go back and adjust Q1 retroactively. That payment is done. So now you've probably underpaid somewhere, you've got a bigger tax bill coming, and here's where the 401k part gets brutal. Your 401k contribution, even though it's deductible, does nothing to reduce the quarterly payments you've already made. It reduces your annual tax liability, but those quarterly payments are already gone. So you're sitting there trying to pay estimated taxes and fund a retirement account at the same time, out of the same pool of money, and that pool is not infinite. And it gets worse because of self-employment tax. This is the one that really stings. When you work for an employer, your employer pays half of your Social Security and Medicare taxes. When you're self-employed, you pay both halves yourself. That's 15.3% of your net self-employment income, 12.4% for Social Security, 2.9% for Medicare. And here's the thing nobody says clearly enough. Your 401k contributions do not reduce your self-employment tax. You can contribute every dollar you legally can to a solo 401k, and you still owe that 15.3% on your net earnings. So the tax deduction you get from the 401k is real, but it's only working on your income tax, not on the SE tax that's quietly taking a massive chunk first. For a freelancer earning $120,000, that's over $18,000 in SE tax alone, before you even think about income taxes or retirement savings. But here's where it gets interesting, because there's a completely different account that actually does help with that SE tax problem, and most freelancers either don't know it exists or don't realize what it can actually do. If you have a high deductible health plan, and a lot of freelancers do because it tends to be the most affordable option when you're buying insurance on your own, you are eligible to open a health savings account, or HSA. And the reason this matters so much is the tax treatment. A traditional 401k gives you a deduction on your income taxes. An HSA gives you something much more powerful. It's triple tax advantaged, meaning contributions go in pre-tax, the money grows tax-free, and withdrawals for qualified medical expenses come out completely tax-free. No other account in the tax code does all 3 of those things simultaneously. But here's the part that almost nobody talks about. HSA contributions are not subject to self-employment tax. A 401k contribution reduces your taxable income, but it doesn't touch your SE tax base. An HSA contribution actually reduces your net earnings from self-employment, which means it cuts into that 15.3% calculation directly. So a freelancer making $120,000 who puts $5,000 into an HSA instead of a 401k saves an additional $765 in SE taxes that year on top of the income tax deduction. That might not sound life-changing on its own, but stack that over 5 or 10 years, and you're talking about real money that a 401k simply cannot give you. And there's a strategy that takes this even further. One tax advisor's client had a high deductible plan, opened an HSA, and instead of using the HSA money to pay her medical bills as they came up, she paid those bills out of her regular checking account and kept every single receipt. She did this for 5 years. Meanwhile, her HSA balance kept growing through contributions and investment returns until it crossed $28,000. Then she submitted all those accumulated receipts at once and reimbursed herself in a single tax-free withdrawal. The IRS has no rule that says you have to reimburse yourself immediately. You just need the receipts and the expenses to be legitimate. It's completely legal, it's genuinely underused, and it's one of those things where once you know about it, you can't believe more people aren't doing it. So the HSA is something you should seriously look at if you haven't already. But there's a different kind of trap that's more about timing than account type. And missing this one doesn't cost you hundreds of dollars. It costs you tens of thousands in a single year. If you want to open a solo 401k and make employee deferrals for 2025, you must have the plan established by December 31st, 2025. Not funded by then, not filed by then. Established. The paperwork has to be done before the calendar flips. And if you miss that deadline, here's what happens. You can still make employer profit-sharing contributions for 2025, but you permanently lose the ability to make employee deferrals for that year. Those are gone forever. To understand why that matters, you need to see the math. At $100,000 in net self-employment income, a solo 401k allows you to contribute roughly $42,235 total, about $23,500 as the employee deferral, and about $18,135 as the employer profit-sharing piece. A SEP IRA at the same income level lets you contribute around $18,587. Miss the December 31st deadline, and you've essentially turned your solo 401k into a SEP IRA for that year. You lose the $23,500 employee deferral component, and there is no way to get it back. That's not a $200 penalty. That's a $23,500 hole in your retirement strategy for the year. The reason so many freelancers miss this is that December is already the most chaotic month of the year if you're running your own business. You're managing year-end client work, thinking about Q4 taxes, trying to figure out your income for the year, and somewhere in all of that, setting up a retirement plan just doesn't feel urgent. Until February, when you realize what you missed. So if you're watching this anywhere near the end of the year, that's not something to put on a to-do list for next week. It's something to do this week. Now, even if you get the account set up on time, there's a calculation error that about 80% of freelancers make when they try to figure out how much they can actually contribute, and it can throw your numbers off by tens of thousands of dollars. Here's the math trap. To calculate your employer contribution to a solo 401k, you don't just take your income and multiply by 25%. You first have to calculate your net profit from self-employment. Then you subtract half of your self-employment tax from that number. The result is what the IRS calls your net earnings from self-employment, and that's the base you use for the contribution calculation. Most freelancers skip the second step entirely. They plug their gross revenue into an online calculator, or sometimes even their net profit without the SE tax adjustment, and the number they get back looks great, until their accountant runs the real numbers in April and the actual contribution limit is significantly lower. If you earn $100,000 in gross revenue, but your business expenses bring your net profit down to $70,000, your employer contribution ceiling just dropped by 30%. And you don't find out until tax season, at which point you may have already overcontributed, which creates its own set of problems with the IRS. The fix is to use your actual net profit after expenses, subtract half your SE tax, and then run the contribution formula. It's a little more work, but it's the only way to get a number you can actually rely on. That said, even if you nail the math, there's a deeper problem with solo 401ks that has nothing to do with calculations and everything to do with the nature of freelance income itself. Freelance income doesn't come in steady monthly installments. It comes in waves. You might have an incredible Q1, a slow Q2, a disaster of a July, and then a massive project land in October. The problem is that retirement contribution decisions, especially with a solo 401k, often get made based on how things look at one point in the year, and freelance income rarely stays where it was when you made that decision. So you commit to maxing out your contributions in January after a great year. By June, you've hit $40,000 in income and you're feeling good. Then July is dead. August is dead. September, you land one small client. Now you've got money sitting in a retirement account that you genuinely need to cover business expenses, and you can't get it out without paying taxes and a 10% penalty. A SEP IRA or solo 401k sounds incredibly powerful when income is flowing, but the flexibility cuts both ways. The contribution you made when things were good doesn't know that things slowed down. This is one of the reasons some financial advisors recommend that freelancers with highly variable income keep a larger cash buffer before aggressively contributing to retirement accounts. Not because retirement savings don't matter, but because locking money away in an account you can't access without penalty is a real cost when your income isn't predictable. And speaking of costs you don't see coming, if you've been using a SEP IRA for a few years and you're now thinking about doing a backdoor Roth conversion, there's a tax rule that's going to ruin your day if you don't know about it in advance. The backdoor Roth is a strategy where you make a non-deductible contribution to a traditional IRA and then immediately convert it to a Roth IRA, effectively getting money into a Roth even if your income is too high to contribute directly. It's a legitimate strategy and a lot of high-earning freelancers use it. The problem is the pro rata rule. Here's how the IRS looks at it. If you have any pre-tax money sitting in any traditional IRA, SEP IRA, or simple IRA, as of December 31st, the IRS doesn't let you treat your backdoor Roth conversion as purely after-tax dollars. Instead, it looks at the total balance of all your IRA accounts combined and calculates what percentage is pre-tax versus after-tax. Then it applies that ratio to your conversion. So let's say you want to convert $7,500 to a Roth, but you also have $93,000 sitting in a SEP IRA from years of contributions. The IRS looks at your total IRA balance of $100,500, sees that $93,000 of it is pre-tax, and says 93% of your conversion is taxable. You owe income tax on $6,955 of that $7,500 conversion. The tax-free Roth strategy you were counting on just became a tax bill you weren't expecting. The solution exists and it works. You roll your SEP IRA balance into a solo 401k before doing the backdoor Roth. Because 401k balances don't count in the pro rata calculation, only IRA balances do. But almost no freelancer knows this in advance. They find out about it when they're already mid-conversion and the math stops making sense. So if you're currently holding a SEP IRA and you're planning to do backdoor Roth conversions in the future, that rollover is something you want to plan for now, not after you've already started the conversion. Now let's talk about the actual numbers comparison between a solo 401k and a SEP IRA, because this is one of the most widely covered topics in freelance finance, and it's almost always presented in a way that misses the most important detail. The common version goes like this. Solo 401ks let you contribute more money, especially at lower income levels, so they're better. And that's broadly true. At $100,000 in net SE income, a solo 401k allows roughly $42,235 in total contributions versus $18,500 for a SEP IRA. At $200,000, the solo 401k allows around $6,405 versus $37,074 for a SEP IRA. The SEP IRA doesn't actually catch up to the solo 401k until your net SE income gets above roughly $305,000. So for most freelancers, the solo 401k wins on contribution limits, and that part is real. But here's what the comparison usually skips. A SEP IRA requires almost no administration. You can set it up in an afternoon. Contributions can be made in a single step before your tax filing deadline, including extensions, and there are no ongoing plan documents to maintain. A solo 401k requires you to maintain plan documents, track employee and employer contributions separately, and once your plan assets cross $250,000, you're required to file Form 5500 EZ with the IRS every year. That's not a huge burden, but it is a real one. The practical result is that a lot of freelancers open a solo 401k, get excited about the higher limits, and then don't actually maximize it because the administrative friction makes it easier to just not deal with it. They contribute something, but not the amount they could contribute. A SEP IRA that you actually use consistently often beats a solo 401k that you contribute to haphazardly. The best account is the one you actually manage. There's one more angle on the solo 401k that most people in the freelance space never get to, and it involves a strategy called the mega backdoor Roth. If you're a high-earning freelancer and you've been trying to figure out how to get more money into a Roth account beyond the standard contribution limits, this is how people do it. With a properly structured solo 401k that allows after-tax contributions, you can put in after-tax dollars above the standard limits and then convert them to Roth within the plan. The pro rata rule typically isn't a problem here because the conversion happens inside the 401k itself, not across different IRA accounts. But you need to convert quickly after making the after-tax contribution because any earnings that accumulate before conversion become taxable when you eventually withdraw. Here's the trap, though. If you miss the December 31st establishment deadline and try to set up your solo 401k in early 2026 instead, you lose access to this strategy for 2025 entirely. You can still make employer profit-sharing contributions and possibly after-tax contributions, but the mega backdoor Roth pathway for 2025 is closed. A high-earning freelancer who was planning to use this strategy finds out in February that they can't access it for the previous year. And that's a year of potential tax-free growth that's simply gone. If you're finding this useful and you want to go deeper on tax strategies specifically for freelancers, there's another video on this channel that covers how to structure your business entity to reduce your tax bill. It pairs directly with everything we're talking about here, and it's worth watching after this one. And if you haven't subscribed yet, this is the kind of content we put out regularly, so it's worth hitting that button now. Let's talk about one more trap that hits B2B freelancers especially hard, and it's connected to how you account for income. If you invoice a client for $50,000 in December and you use accrual accounting, that $50,000 is recognized as income in December, even if the client doesn't actually pay you until March. Which means you owe estimated taxes on that income in the quarter it was earned, not the quarter you received the cash. And if you've been making 401k contribution decisions based on that income, you've now committed money to a retirement account based on revenue that hasn't arrived in your bank account yet. In B2B freelancing, net 60 and net 90 payment terms are completely normal. A client going 90 days before paying is not unusual, and a client going bankrupt or disputing an invoice happens too. If you're on accrual accounting and you've over-contributed to a retirement account based on income that never actually came in, you've got a real problem. You've locked money away that you needed for operations, and you're dealing with a tax situation that doesn't match your cash reality. Most freelancers use cash accounting, which avoids this specific issue. But if you've ever been advised to switch to accrual for any reason, it's worth understanding how that change interacts with your retirement contribution strategy. Now, the last thing I want to cover is something that most freelancers earning six figures haven't seriously considered yet, and it's probably the highest leverage tax move in this entire video. Solo 401ks are designed primarily for sole proprietors. But if you elect S corporation status for your freelance business, the math on retirement contributions and self-employment tax changes in a significant way. Here's how it works. As an S Corp owner, you pay yourself a W-2 salary, and the rest of your business profits come to you as distributions. Those distributions are not subject to self-employment tax. The 15.3% SE tax only applies to the W-2 salary portion. So if you're earning $200,000 and you pay yourself a reasonable salary of $80,000, you're only paying SE tax on $80,000 instead of $200,000. That alone can save you $18,000 or more per year. But here's where the 401k piece comes in. Your employer contribution limit for a solo 401k is calculated as 25% of your W-2 wages when you're operating as an S Corp. So you can pay yourself a lower salary, take the rest as distributions, and still maximize your 401k contributions based on that salary. You're reducing SE taxes and building retirement savings at the same time. For a freelancer earning $190,000 with a $190,000 salary plus the employee deferral, you're hitting the contribution cap the hard way. But structure it as an S Corp with a reasonable salary, And the same total contributions become much more tax efficient because more of your income is flowing through as distributions that don't trigger SE tax. The combined effect, lower SE taxes, maximized 401k contributions, potentially $70,000 or more in annual retirement contributions for high earners, is genuinely significant. The reason most freelancers don't do this is that S-Corp formation costs somewhere between $1,500 and $3,000 and requires quarterly payroll filings. It's not complicated, but it's a real administrative step. The mistake is never actually running the ROI calculation. If you're earning $120,000 or more as a freelancer, the annual tax savings from S-Corp status almost always exceed the cost of setting it up and maintaining it, often by a factor of 5 or 10. But nobody does the math because it feels like a big business thing and not a freelancer thing. So let's pull all of this together. The 401k isn't a bad account, but it was designed for employees with predictable salaries, employer matches, and HR departments handling the paperwork. When you apply it to freelance income, the friction points multiply fast. Quarterly estimated taxes and 401k contributions are pulling from the same pool of money at the same time, and the 401k doesn't reduce your SE tax the way people assume it does. The HSA is a genuinely better tool for a lot of freelancers, especially once you understand the triple tax benefit and the SE tax reduction, and the receipt reimbursement strategy makes it even more powerful over time. The December 31st deadline for solo 401k establishment is not a soft guideline. It's a hard cutoff that permanently costs you the employee deferral for that year if you miss it. The net earnings calculation trips up the majority of freelancers and leads to contribution errors that don't surface until tax season. Income volatility means the contribution you made in a good month can become a liability in a slow one. The pro rata rule destroys backdoor Roth strategies for SEP IRA holders who don't know to roll their balance into a solo 401k first. And for six-figure freelancers, S-Corp election combined with a solo 401k is probably the most underused tax strategy in this entire space. At the start of this video, the conventional wisdom was, open a solo 401k, contribute as much as you can, and you're doing great. What you know now is that the account is only as good as the strategy around it. The timing matters, the math matters, the account type matters, and the business structure you're operating under matters. Getting one of those wrong doesn't just leave money on the table. It can actively cost you money in taxes and penalties that you didn't need to pay. If you have a freelancer friend who's been putting money into a SEP IRA without knowing about the pro rata rule, or someone who almost missed a December 31st deadline, send this video to them. Drop a comment below with which of these traps you've personally run into. I read every single one, and it helps me understand what to cover next. And if you want to go deeper on the business structure piece, the S-Corp video is up next. Watch that one before you make any decisions about how your freelance business is set up. It'll be worth your time.